Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into Aytu BioPharma's latest filing and things might get a little wild. I hope you're not afraid to ask your doctor some important questions, and as always, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come say hi. Aytu BioPharma is looking to raise money. They're offering shares of their common stock, or for some buyers, something called pre-funded warrants. Think of it as a choose-your-own-adventure in the stock market, but with potentially less thrilling outcomes. So buckle up, because we're going to break down exactly what Aytu's up to, what those pre-funded warrants are all about, and what it all means for investors. First, some basics. This isn't exactly a company blazing new trails. They're a non-accelerated filer, which basically means they aren't one of the big players in the market. This also means it's a smaller reporting company, which basically means they get to share a bit less with the public. But to top it off, it's chosen not to use the extended transition period. Don't worry, that's some technicalities that the auditors care about. Now, let's talk numbers. Aytu wants to sell 741,573 shares of common stock, or those pre-funded warrants 78 cents per share, based on where their stock closed recently. They're even giving the underwriters, basically the folks helping them sell these shares, an option to buy even more. What's with these pre-funded warrants? Well, imagine you wanted to buy a bunch of Aytu stock but were worried about owning too much. The warrants allow you to get around this. Each warrant lets you buy a share of common stock later for a tiny price of $0 without immediately increasing your ownership percentage. There are limitations to prevent you from becoming an owner of more than 4.99% or 19.99%, but still a neat trick. Where's this money going? That's the million-dollar question, and Aytu's management has broad discretion, which means they get to decide. It could be for anything from paying bills to buying other companies. While that can be concerning that investors have no say on how their money is used, this actually isn't an uncommon disclosure that public companies do. Let's check out some key numbers. As of March 31, 2025, they have $18 million in cash and 34.8 million total stockholders' equity. But here's a kicker, they also have a whooping accumulated deficit of $313.7 million, which basically means they lost that much money throughout the lifetime of the company. But there's a plot twist. Aytu is hoping to strike a deal to commercialize a new antidepressant called XUA, recently approved by the FDA, which seems like a significant opportunity. If this materializes, a good portion of this fundraising is going to cover this EXUR deal. One major risk, however, a generic company is challenging their ADHD drug Adzenys by saying that Aytu's patents aren't valid. If they succeed, cheaper versions of Adzenys could flood the market, hurting Aytu's sales. They will be heading to court in December 2026 to try and prevent the generics from going to market. Okay, let's dive into the financials from last year. Their total net revenue was $65.1 million. Gross profit was $49 million, and cost of sales was $16.1 million. They are burning a lot of money. General and administrative costs were at $19.19 in research and development. Pru and $2.7 million, which resulted in a net loss from continuing operations of $12.5 million. Ouch! And to add to the pain, they also lost $4 million due to changes in the value of their warrant liabilities. A good takeaway here is that when a biotech has warrant liabilities, stock volatility is bad for their earnings. Including loss from discontinued operations, their total net loss for the year 2024 was $15.89. Looking at product lines, their ADHD portfolio is the rising star, bringing in $57.7 million. But their pediatric portfolio isn't doing so hot, just $7.2 million, a big drop from the year before. Gross profit percentage actually increased to 75%, so at least they are making more off of the products they are actually selling. Financially, they also replaced a large debt with a new loan with better terms. This shows that the new credit rating likes where they are going. Finally, they expect their income tax expense to rise in the future due to more profits. The auditors flagged that estimating revenue involved tricky judgments, especially around savings programs and how much inventory is sitting in warehouses. This boils down to if management truly know their sales numbers or are making best guesses. One thing to note is that Aytu has the option to sell $100 million in stock under a shelf registration, giving them flexibility to raise money when they need it. Looking at the fine print, this offering isn't for everyone everywhere. There are restrictions in places like Australia, Canada, and Europe, so international investors should take note. And of course, Aytu is promising to protect the underwriters from certain legal troubles related to this offering. Finally, it's important to highlight some things that are worrying for the company to keep in mind. These are called risk factors, and they are not to be ignored. 1. Aytu gets to decide how to spend the money raised, and they might not use it wisely. 2. Selling more shares might make the stock price go down. 3. Aytu has announced it is looking at being acquired. That means that if a deal doesn't happen, this could cause distractions and stock price swings. Aytu BioPharma presents a mixed bag. They're trying to turn things around by focusing on profitable products and exploring new opportunities in mental health. However, they face significant hurdles, including generic competition, ongoing losses, and reliance on a few key customers. One positive is definitely a strategic shift that appears to be well underway. By killing less productive units, they are likely to turn around profitability. They are also exploring new acquisitions and licensing deals to further solidify their portfolio. A major risk remains their ability to compete effectively against generic drugs, which would severely impair their sales. In conclusion, Aytu is at a crossroads. This stock could have a high return, but it definitely has even more risks to keep in mind. Alright, that's our breakdown of Aytu BioPharma's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.